Okay. In this part, we are interested to explore the revenue and expenses and what kind of accounting issues might arise in these aspects. I mean, the revenue and the expense. So we know that revenues and expenses are represented in the statement of comprehensive income, or you might say profit and loss statement or income statement, whatever you say. And we know that we recognize revenue uh, considering that these are economic resources and we have earned these economic resources during a time period, because we have to present the revenue and expenses not on a specific day, but for over a time period. So when we when we recognize revenue, I mean the accountants or accounts department managers recognizes the revenue and present the revenues in the financial statements. But as a financial analyst, we need to check that the revenues have been recognized properly, and revenues have been recognized in that period when it is due, and revenues have been recognized following the financial standards, and the revenues are recognized in a way so that there is no suspicion that revenue recognition is not appropriate. So these are some questions or some issues an analyst will explore. So based on the financial standards, revenue is considered. I mean, when revenue is occurred, it is only considered the revenue recognition when we have these two conditions fulfilled. So one condition is that the product or the service, it has been delivered. It has been delivered to the door of customer or to the authority of the customer. And second condition we like to check is that the cash collection from that transaction is most likely to be received by the firm. So we know that the sales can occur on a accrual basis, but we believe that on a certain within a certain time period, we will be able to generate or we'll be able to collect the cash. So when it is reasonably likely, in that case, we recognize that this revenue has incurred. So this definition of revenue is very straightforward, but now we like to see some areas in which we will see that it is challenging to recognize revenue properly, and it is the task of financial analysts to explore that where there is a suspicion that revenue has not been recognized properly by the accounts. Okay, so we like to check some areas in which revenue is likely to be recognized improperly. Okay, so first case we like to discuss is that sometimes customers pay in advance for a product or for a service. It can be for physical product or it can be for service, whatever it is. So if it is for example, casualty insurance, in that case, you have accepted revenue in advance for service. But if it is the subscription for a magazine, say a hard copy, in that case, you are considering this is an advance received from customer for the purpose for this product. Okay, whatever it is. The thing is that when you are taking money in advance, but you still have the question whether you have delivered your service or product to the door of customer properly. this can be a question that customer has already paid for you, has already paid for your product, but a customer has not received the product or customer has not received the service. In that case, how can you recognize the revenue? So the question is that you can consider or you can recognize revenue only when you deliver the services to the customer. Okay. So one classic case is that uh, sometimes, say in an IPS company like Rohim Afros. So when you purchase the IPS from Rohim Afros will provide you the IPS product and also provide you a service contract. In which they will check your IPS for at 2 months interval. So in that case, you are paying for the whole product IPS plus the service contract in full. You are paying the full in advance. Okay. So there is no question that when IPS has been delivered to you and it has been installed by the serviceman, they have recognized the revenue portion for the IPS. But out of the payment they have taken from you, it also includes a payment for service charge, and service is yet to be delivered to you. Service is yet to be delivered to you because it will be provided to you in next 1 year or in next 6 months or in next 1.5 years in this way. So now this amount of revenue, what you have collected as a part of service charge, how you will consider or how you will recognize this part in your revenue? Okay, there's a question. So it is possible, if it is possibly easy that you can identify that out of the 20,000 payment, 15,000 is for IPS and 5,000 is for service charge. In that case, it is easy that you recognize only 15,000 revenue now and you do not recognize 5,000. Okay. Now, what is the that when you will recognize this revenue? You will recognize this revenue only when say 5,000 is for 10 months. Okay. So when in each month you are recognizing, you are delivering service or you are providing the checking service, in that case, you recognize the revenue for that month. And then say for 6 months, you have already provided service, then for 6 months, you recognize the revenue. Okay. So that in this way, it is usually happened. Okay. But sometimes you do not have the information, I mean, as an analyst, that how much has been taken for the product and how much has been taken for the services which will be delivered in a future time. In that case, it raises question to you as a financial analyst that how can you separate this out? It's particularly challenging. So in that case, you need to explore more. You need to compare with other companies that what is the likely amount of the revenue which is amount of sales which is likely to be delivered later. So this kind of issues arise, and so the standard is that when you deliver the service, and in that case, that amount is only recognized, and the remaining amount will not be recognized as revenue. Remaining amount will be recognized as something in the balance sheet. Now, the question to you, what is that something? Out of 5,000, say 1,000 amount of service has been delivered. That's why 1,000 revenue has been recognized. But what will happen to the 4,000? Will the remaining 4,000 be complete out of the financial statements, or it will be somewhere? it will be somewhere in the balance sheet as a liability, as an unearned revenue good. So the issue is that sometimes it happens, uh, managers have a tendency to overestimate the revenue of a quarter. Say, let me take you a case that right now we are in 2020. So in 2021, we have quarter one, quarter two, quarter three, quarter four. So quarter four reports is still be declared. We are in February. Some companies are providing, or some companies are yet to provide the quarter four result. Okay, we are now in 2020 quarter one. So let's say on the last day of quarter four, say December 31. Let me assume that this was a working day. So on this working day, some orders of sales have been received by a company. Okay. But you see, the order for sales has been received. Order for sales have been received. But the products or services have not been delivered. It is likely that the products or services of that order, which has been received in quarter four, will be delivered in 2020 quarter one. But if managers feels that my performance in quarter four has not been good because I couldn't generate adequate sales, managers will have a tendency to recognize the sales or recognize the revenue which would happen in quarter one, but recognize the revenue in quarter four. Have you got it? I have received the sales order in quarter four, but why they cannot recognize the revenue in quarter four? What's the reason? They can recognize the revenue in quarter four by saying that we recognize revenue considering free on board. It is a term used in the accounting which indicates that it is not necessary that customer has received or the product has reached to the customer's place. As long as you have boarded the goods on the truck or on the container or on the shipment, in that case, you can recognize the revenue. But the principle is kind of FOB destination. In that case, revenue can only be recognized when the products reached at its destination. I mean, in the customer's place, customer has acknowledged that receipt. So what do you think? Out of these two terms, FOB and FOB destination, which one is likely to be indication that companies is practicing aggressive revenue recognition? FOB or FOB destination? FOB, yeah. So you got it. Now you see that what I was asking, that if a company wants to boost up the quarter four performance, the company will take the FOB or the company will take the FOB destination? The company will take the FOB. Okay. So these are the ways that how revenue can be inflated. Okay. So revenue is the first line item. If you inflate the first line item, it will have a significant impact on the remaining item. I mean, on the last line item. I mean, on the profit or the net profit, whatever you say. Okay. Next thing I like to highlight We'll not discuss each and every point, but I like to give you the way, I like to show you the way that how can you understand each of these challenging areas. Okay, next thing, regarding the revenue analysis. Products or services are provided over multiple years, as is the case for long-term construction contract and frequent flyer award. Okay, so let me take this long-term construction contract. So you see, do not forget the two conditions. One is the product or services has been delivered. This one, it has been delivered. And the second thing is cash collection is reasonably likely. Okay. Sometimes products or services are provided over multiple years. In that case, there is no ambiguity. There is no ambiguity regarding the payment. How? So if there is a kind of advance payment in this way, if there is an advance payment, but here you see the issues which are likely to be arise, likely to arise are this. Say you have taken a construction project and you are expecting that the construction project will be delivered to the customer by 5 years. Okay. And you are preparing your financial statements, I mean the statement of comprehensive income for 1 year. So over a period of time of 1 year. So you have received say 5 million taka for the construction project, which will be delivered after 5 years. Okay. You can think of the case of Eastern Housing. Eastern Housing sells flat to their customers, and they receive the sales price of their flat before delivering it to the customer, and they recognize that the product will be delivered after a certain time period. Okay. So you see that say that company has received 5 million, but the construction of the flat or construction of the building will continue for 5 years. Now say this is 2022. Now the question is how you will recognize this 5 million, which you have received today, but you are expected to continue your construction works for next 5 years. So how can you recognize this 5 million revenue? So your construction will continue for multiple years, and it will take time for the customers to receive the product. And in that case, what is the practice that there is a concept which is known as percentage of completion. Percentage of completion method. So in this way, what is done? So that flat would require 1 million expenses in total. Okay. So in 2022, after the completion of 2022, you have recognized that out of the 1 million expenses, which is likely to be incurred for this flat, 0.2 million has been already incurred. I mean, out of the 1 million expected expenses, you have already incurred 0.2 million for this flat in 2022. So based on this information, what do you think? How much of the work is completed? Is there any information here from the data I have been given to you? Is there any information you can draw based on the data I have given to you? That is it reasonable that if I say that 20% of the work has been completed, 20% of the work has been completed, can we say? So if we say now the way of recognizing revenue is that out of the 5 million revenue which you have received in 2022, you cannot recognize the total 5 million. Out of the 5 million, take the 20%, which is 1 million. So you show the 1 million in the 2022 income statement as revenue, and show the 80% of the 5 million as deferred revenue. Okay. So if the managers have an incentive that I would like to pay less taxes in this year, what do you think? They will underestimate the percentage of completion method, or they're likely to overestimate the percentage of completion? What do you think? I have a incentive that I will pay less taxes. I will underestimate so that my revenue will be understated. Okay. So in this way, you will look at other issues which pose challenges to the financial analyst make the revenue analysis. Okay. So I have explained some cases with respect to the first challenge and the second challenge. Okay. Next thing I would like to discuss is the expense analysis. Yeah. So you see, the opposite side of the revenue analysis, we need to make the expense analysis. Okay. Before proceeding, let me respond to a query made by you. If a firm gets sales order in Q1 and recognize it as sales in Q4, does it indicate that it has followed the FOB destination? I like to know you refer Q1 of which year? Are Q1 and Q4 are of same year, or they are of different year, or specifically of which year? So write it down, so then I can reach out to you. Of the same year. Okay. Yeah. Okay. Sales order in Q1 and recognize it as sales in Q4. Does it indicate that it has followed the FOB destination? Okay. We can claim that the company has followed the FOB destination only if we have a proof that the company for this particular transaction has delivered the goods to the customer's place in Q4, not in Q3 or Q2 or Q1. Okay. In that case, we can confidently say the company has followed the FOB destination. The condition is that in that quarter, company has delivered the goods to the customer. Okay. Okay, now expense analysis. In expense, we use our resources, and we consume our resources, and that declines its value over time. And how much resources we have used or consumed in a time period, we recognize those as expenses. Okay, again, the expense analysis involves the appropriateness of the recognition of expenses in a specific time period or a specific financial year, and whether it has been recognized properly. Okay. So in accounting, there's a principle which are very popular among you, and all of us are conservatism and matching. So I do not like to recap that what we mean by conservatism or matching, but the idea is that the matching, I can recognize expenses in that period only if we believe that, or if we have evidence that the benefits for that expenses have been generated in that particular year, or are expected to generate in that particular year, or we are recognizing that benefit in that particular year. Okay. And we need to establish this relation. So here cost is the expense and the effect is the revenue. So cost of consumed resources have a cause and effect relation with the revenues, and then we can match it with the revenue. If it is true, then we can recognize some outflow of the resources or economic resources as expense. Sometimes we incur some expenses or incur some cost of economic resources for which we cannot prove the cost and effect relation, but we recognize those as expenses because we believe that those expenses are essential during that period in which you are recognizing it. Okay. So that's why we recognize the expenses or economic expense of the economic resources in that period. And sometimes we include some expenses which comes from the consumption of some wealth for which the future benefits will go down. The future benefits for an asset will come down, or if we have some resources on which we are expected to get some future benefits, but if we believe that there has been an impairment on that asset or on that resources, we incur that amount of impairment as expense. And we recognize that over time, the accounting value or the book value of that resource go down or come down. Okay. So let's discuss some examples related to the challenges which might arise regarding the recognition of expenses. So sometimes we have some resources which provide us benefits for multiple years or for multiple periods. So we cannot precisely identify the period in which we have the effect. We cannot precisely relate. We are incurring expenses today, but we are not pretty certain that for these expenses, these huge expenses, when the effect will be in place. Say we have purchased, some fixed asset. We purchased some fixed asset. And for fixed asset, we believe that it will provide benefits to us for multiple years. And we do not know for how many years benefit can be linked with the expenses of fixed asset we have incurred this year. And how can we allocate the expenses for fixed asset? So the general rule is that what we do, we make some depreciation. Make some depreciation practice to apply the matching principle and to allocate the cost of fixed asset over a 5-year period or 3-year period, considering that over the period or 5 years period or over the 3 years period, the benefits of the fixed asset of that particular asset will be realized. And after 3 years or after 5 years of economic life, no benefits of this fixed asset will be incurred or will be generated. So that is the reason that why we make the depreciation. But you see, can you recognize that from the previous classes, we talked about that there is a tendency that managers overestate asset, overestate asset value, and you recognize. So you recognize. So how it is possible if you relate it with the depreciation? If we underestimate the depreciation in a particular year, it is likely that we can be able to overestate the asset value. But what do you think? What is the likely effect of underestating depreciation in a particular income year? If we underestate expenses with regard to depreciation, what is the likely impact? Increase the tax expense, less depreciation, higher income, net income will go up. I like to show that I'm doing good. So by underestimating expenses, I can show it. Okay. And another area which often is discussed is the research and development outlays. Okay. So it is highly uncertain that when the benefits of the research and development outlays will be realized. Okay. So the general rule of thumb is that as there is uncertainty when there will be regarding when the benefits of the research and development outlays will be generated. That's why all research and all in-house research and development outlays are expensed rather than deferring some research and development expenses for future. Okay. But there are some exceptions in which you'll see that if we purchase some research and development from some other company, say it's possible to purchase the research from others. Okay, so say Microsoft has purchased a research and development outlays which have been made by TikTok. In that case, there is a room for Microsoft which have been given in the regulation that what Microsoft can do for the regulation for the research and development outlays purchased from that. They can make it as a capital asset. They can capitalize this amount total. They can show total amount for this as a capitalized asset amount, and over time it needs to be amortized. Okay, so sometimes it is possible that relate the expenses for the research and developments with the benefits we generated in some years, that in 5 years I will generate the revenue for this research and development I'm making today. In that case, we can relate the research and development outlays with the revenue which are expected to incur for this research and development in this next 5 years. Say, for example, for this amount of research and development outlays, I'm expecting to generate benefit of 1 million, 2 million, 5 million, 3 million, 2 million in this next 5 years. So based on this amount, I can allocate the research and development expenses in this 5 years. Okay, so it is also possible. And there are some other issues in expenses analysis. Let me take another example. This is a certain case that environmental liabilities, it is happening right now for carbon emission, companies are in obligation to make compensation to some countries or to some government or to some authorities or to some local government an amount. So that will be an expense, and company or firm has made commitment. But you see, you do not have the idea that how much environmental liabilities you are expecting to incur, and what will be the precise amount. So it is, you have made this commitment that you will compensate the environmental loss or the carbon for the carbon emission, but you do not have enough technology to estimate that how much amount I will be paying or how much amount I'm spending. Okay, so these are the issues which arise in the recognition of expenses. Okay, and there is an issue like obsolescence expense, which arise from the impairment of asset, because when we have an asset, and over time technology changes and subnet technology become obsolete over time. So for that obsolescence, we need to make allocation of obsolescence expense. We need to expense the amount of obsolete asset. So that is the way, and sometimes there is an ambiguity that how much obsolescence has been incurred. I do not know that that current technology what I have, what is the amount of obsolescence I need to recognize. So sometimes, obviously, you have a guidance. If I ask you that, how can you estimate it? So you might say that managers know very well. So when managers know very well, accounting standards already recognize that managers know very well. But when managers are given the task to estimate the obsolescence expenses, managers might use this estimation in to serve his incentive or his purposes, which may reduce the usefulness of the financial statements. Okay, so these are the some areas you need to explore regarding the revenue and expense analysis. And you will find more details about the revenue analysis and expense analysis from the text Business Analysis and Valuation by the Palepu in 2nd edition, not in the 5th edition. 5th edition has skipped this part of revenue analysis and expense analysis. So right now,